Hello and welcome. You're watching All About Your Company. Today is a very interesting name that we're going to speak about. Let's first pull out the charts for this one and you'll see why it looks interesting. Crompton Greaves is what we're going to speak about, but look at the chart. That's the last 1 month with regard to Crompton Greaves. It's up. There's been an uptick of 5.5% on the stock price. But when you look at the last 6 months, the last 1 year, there you go. Last 6 months down 17%. Last 1 year down 23%. And in fact, even over the last 5 years, the stock has given less than zero returns. And in fact, when you look at the 5-year chart, we're sitting at the very bottom of that 5-year chart. So it's not even like it's not just been an underperformer. We're currently sitting at a juncture in this stock price where we're at the low, 5-year low in terms of stock chart, 34% down over the last 5 years. And of course, it's had its ups and downs in the last 5 years. But this is why this one looks interesting. Of course, what I want to know, and are we on the cusp of a turnaround, is really that's the story that one would want to play when it comes to consumer electricals and consumer durables. The first piece is how are durable pricing, what's shaping up with regard to pricing, because what's happened is that margins have come off as a result of raw material prices going up, and therefore do price hikes start to come through is really the question. And what changes with regard to margins if at all price hikes were to come through, and the company does intend to undertake those price hikes. So how much of that gets offset by how much of the raw material price increase gets offset by the price hikes is really what I want to know. The second piece is what's the growth outlook with regard to consumer durables. We've not seen good growth. There has been a drag, especially the fan segment. Can we see a turnaround in calendar year 2026? The third piece is with regard to commodity inflation itself. If that starts to ease, that could be a material positive both with regard to margins as well as with regard to growth, because price hikes may not be required. Point number 4, lighting margins. They have been very strong for the company. Can they sustain is really the question. Point number 5, we are venturing into wires and cables. They are going to talk about new products over the next 4 to 6 weeks, likely from here on. And therefore, what's the kind of market share that they are targeting is what I want to know. Also, growth outlook and margins on solar pumps and rooftop solar. Again, these are 2 new ventures, fast growing for the company, and therefore, what are the margins that they are targeting? Also, in terms of mix, general trade versus e-com, how are they shaping up in terms of margins? How is the margin mix in each of those? And last off is with regard to capex. What is it that we can expect? Now, let's talk about the company. Let's try and understand what the company is about. First off, it's a leading Indian consumer durables company, as one would know. Its core is fans, pumps, lighting and appliances, and it owns both the Crompton brand as well as the Butterfly brand. It acquired the Butterfly brand from Butterfly Gandhimati in 2022, and it's one of the leading global ceiling fan brands, one of the leading ones globally, of course, the leading one in India. Let's talk about the products now. You look at the whole stack of products will come up. Fans and pumps, well, no real bifurcation here, but standing fans, ceiling fans, all of them. And in terms of pumps, both agricultural as well as residential, solar and specialty. Lighting, there's lamps, batons, panels, outdoor, industrial, they cater to all of those. Small appliances under the Butterfly brand, mixer, grinders, irons, cooktops, fryers, large appliances, water heaters, coolers, room heaters. There's large kitchen appliances as well, chimneys, hobs, dishwashers. Under the Butterfly brand, again, we spoke about mixers, but wet grinders, cookers, gas stoves as well is what Butterfly markets. Solar pumps, both off-grid agricultural pumping systems as well as residential grid-connected rooftop solar systems. They deal with both of those. And last off, their new segment with regard to mobile chargers, power banks, stabilizers and wires. While they don't manufacture some of these, they certainly sell them, and therefore will reflect in the top-line growth of the company. Let's give you a perspective of the current revenue mix or FY25 revenue mix. Consumer durables accounted for approximately 75% of the top line. Lighting was around 12 to 13%, and the balance was kitchen appliances, 12 to 13%. So that's really the split. Durables is where a large chunk of the revenue really comes from. Let's talk about geography. 98% is domestic, 2% is export. So the export opportunity could also open up as a result of all that's playing out. In terms of the business model, it designs in-house, it manufactures also in-house, but also through partners. Certain select pockets and spaces, like for example solar, is what they do through their partners, and even mobile accessories, wires and solar, that's all done through third party or through partners. Now you're looking at the EPC model where solar is concerned. That's how they work with regard to solar, but otherwise the sales are all done through their own network. How large is their next network? They have 6,100 partners, 2.4 lakh distributors and 860 service centers through which they service all of their customers. Now let's talk about the key metrics, as we always do on this show. Over the last 3 years, let's look at the journey of the company. You look at the top line growth of around 13%, less than enthusing, but essentially it's the EBITDA and the PAT which hasn't in fact delivered for the company. You look at the flat EBITDA numbers that we've seen over the last 3-year CAGR period. It's just been a 5% EBITDA growth, and the PAT growth has been negative. In fact, from 578 crore, PAT has come down to 564 crore. So cycle has turned slightly unfavorable in that sense. Can it pick up is really the question. We've given this a neutral. Now this is of course your 9-month FY26 numbers on your screen. No growth on the top line. The EBITDA number is in fact down 8%. Margins have contracted but have started to recover, mind you viewers, and profitability is in fact down. So that's really the 9-month picture with regard to the company. Now let's talk about the second metric, margins, and you'll see that the margins have started to see a lift. In fact, let me read out numbers to you. Q1 FY26 margins were at 9.6, Q2 was at 8.2, and Q3 is now at 10.3. So margins have started to recover, and that's the key positive. Now you can see the 11.3% margin number in FY25. It's dipped lower now, but can we continue to see an uptick going forward? And maybe that top line growth may well aid margins going forward. But you look at the FY22 base year where margins were at 14.5%. It's come off substantially from there. So a question is it product mix shift, or is the kind of 10%, 10.5 to 11% maybe margins something that the company is looking to clock on a consistent basis? That's the balance sheet, of course, for you. You're looking at a book value of around 3,400 odd crore. When you're looking at H1 FY26, it is at 3,399 crore. Excuse me. So that's on book value. When you're looking at the market cap, it's roughly 17,000 crore. The borrowing number has been reduced to 0 from 300 crore in FY25, and it sits on a cash bank account balance of around 34 crore. Largely the net debt to cash, or rather the net debt was largely has remained the same, FY25 versus H1 FY26. Let's talk about the return ratios now, and in terms of the return ratios, you'll see that it's clocked a return ratio of almost 22%. Okay, before that, let's look at cash flow. We're looking at cash flow from operations, which has been fairly healthy. The conversion from EBITDA to cash flow is not really a concern for a company like this, and therefore we'll give that a clean thumbs up and let it go. Return ratios, you'll see it fluctuating between the 16 to 22% mark, well ahead of the 15% that one would come to expect of Indian companies, and therefore we've given this one a thumbs up as well. Shareholding pattern, now what you're seeing is no promoter ownership here, but you'll see strong FI and DI participation here, and there are some big FIs and DIs within that basket, and therefore we've given this a neutral, because the likes of an HDFC mutual fund, for example, hold significant chunks of the company, and therefore that's something that that gives you comfort from a shareholder standpoint, that there are some large shareholders there. When you're looking at the analyst view now, 37 buy calls given by analysts, no sells and 2 holds. The upside on this one is 26%. That's the average analyst upside for the next 12 months that Bloomberg threw up. When you're looking at valuations as well, and that's a strong thumbs up, by the way, from an analyst community standpoint. Valuations also, 1-year forward price to earnings is at 27 times. The current price to earnings is around 34 times. And you're looking at a 5-year range of 23 to 48 times. And therefore, it's sitting very, very close to the lower end of the band. Mind you, there's a 5% lift in the stock price as well. The 5-year average is at 35 times, mind you. So that's something that you want to keep your eye out on as well. Valuations not exactly looking as expensive. If growth were to pick up, this could look very, very interesting. Anyway, what we'll do is dive into a quick break. On the other side, we'll speak with the CFO of Crompton Greaves. Stay with us. Welcome back, and of course, we have already tried to sum up Crompton Greaves, and we have with us Mr. Kaliswaran Arunachalam, who's the Group CFO and Head of Strategy at Crompton Greaves Electricals. Mr. Arunachalam, great having you. Let me first start off by understanding, of course, top-line growth, but more importantly, the margin picture. Raw material prices have been a headwind to margins for you. So let me first understand that piece before I go to top line growth. I know that's where all the game is going to change. But with regard to margins, what are you seeing in terms of the picture on the raw material side of things and on the pricing side of things? What can we expect?
Hey, hi, Grun, and thanks for having us. See, there has been an uptick in the commodity prices that we have been seeing it for the last 3 to 4 months, and we expect this volatility to continue for a couple of quarters, post which the commodity prices can cool down. That's our current view. To offset the commodity price increase, there are a few actions that we are undertaking. As you would know, we have a flagship cost program known as Unnati, where we work on a productivity of about 2 to 2.5% cost reduction every year. Then we are also working on mix, where we are trying to premiumize the portfolio where our margin profile is better and how we use that to help the commodity inflation set. On top of it, there are conscious price interventions that are also being brought in to ensure that wherever we have to pass back price increases, we are continuing to do that. The first round of price increase has already happened in January. We are planning for 2 more rounds of price increase in Q4 and Q1. I think put this together, we should be able to largely ward off the commodity inflation that we are seeing right now.
And therefore, Mr. Arunachalam, should margins revert back towards 13% despite the price, despite the commodity price volatility you're seeing? Is that something one can realistically expect?
See, we don't give a forward guidance, but having said that, you have seen some of these playing out in the last quarter itself. ECD margins have started moving up. Lighting, for example, we are now industry leading in our margin profile. Butterfly margin continues to move quarter on quarter. So overall, it's already in play. We expect the margins also to come back as we move forward.
Okay. Now talk to us about top line. There are plenty of levers on your top line front, and you've done well, frankly. 13% top line growth. Really, the drag over the last 5 years on the stock price has been with regard to the margin decline that we've seen, and top line not growing as well as the potential of Crompton actually is. I'm trying to understand, in terms of wires and cables in particular, what's the kind of market share that you're targeting, maybe over the next couple of years? Is there a ballpark number you can give us?
See, before I get in specific into wires and cables, there are a few initiatives that we have taken as an organization to be growth oriented. About 2.5 years, we launched what is now called as Crompton 2.0, where we clearly said, how do we reposition the organization to be more consumer centric and also drive technology to ensure that the consumer problems are solved for via the product profile that we are having in today. Underlying to that, we also took a clear growth aspiration via expanding our TAM. We used to be a TAM of about 50,000 crores. Subsequent to Butterfly acquisition, that moved to about 80,000 crores. And we had a called out strategy of taking this TAM from 80,000 crore to about 2 lakh crores. As we speak on that, we have already expanded this to 1,60,000 crores in last quarter. This is on the back of 3 new category launches that we introduced: solar pumps, solar rooftop, and wires. We are looking at few more categories that might come in the coming quarters, which we will talk about it as and when the time comes in for the product launches. Specific to your question on wires, this is something that has been under the works for more than a year now. It's a carefully thought out category that we are entering in. We understand there are consumer challenges or consumer problems that we can address by bringing in a meaningful value proposition in the wire segment. This is a very large TAM. This is close to about 40,000 crores. If you look back, Crompton has never entered any category to participate. It was always to attain leadership. We started as a fans India player. Today, we are world's #1 fan company. We are India's #1 residential pumps company. Geysers, today we are #1 in e-com and a top 2 player in general trade. Post acquisition of Butterfly, we are India's just entered some solar pumps. I'm sorry, we entered some time back. We're already a top 3 player there. Lighting, we continue to be a top 3 player. So our aspiration to enter into wire is also backed by the fact that there is a potential for us to be a meaningful player in this segment in the coming 3 years. This is on the back of 2, 3 things. We have got a great brand. Crompton is something that people have grown up with. Of Indian household, go-to-market is one of the best in the industry. We touch about close to 300,000 outlets, which is probably the most distributed for durable segment. We believe there are synergies available on that go-to-market will help us to place these categories also that we are talking about. Third, we talked about some of the differentiation that we also want to bring in from a product value proposition, which should start attract consumers towards Crompton. So that's the rationale, and that's the potential that we see, and how do we scale it up from there.
Understood. That's a very 30,000 feet view, and I know it's difficult to get guidance out of you. But would a 10 to 15% kind of growth clip be a minimum aspiration for you, given the kind of size that that you cater to now, versus what you what size you currently are at in terms of revenue?
Absolutely. We are looking at a 15% growth rate. I expect the revenue in the next 5 years. This is going to be aided by double-digit growth in the current categories where we are present, and additional revenue coming from the new categories. So we are looking at a 15% growth rate in the next 5 years and double the business from where we are today.
And Mr. Arunachalam, can the lighting margin sustain for you, or is there a challenge there?
See, lighting margin is something that has an outcome of extremely planned execution that has happened on ground. There are a few things that we worked around it. One, we knew that the market is moving towards ceiling lights, and Crompton was under-indexed to ceiling lights. Over a period of time, the saliency towards ceiling lights has been increased by bringing in meaningful product gaps that got to be addressed. Now, today, what used to be about a 30-35% ceiling portfolio of the entire bulb batten ceiling category is close to 50%. It also comes with a higher margin profile. Second, we also have now ensured that the fit purpose requirement that we need to work on lighting. As a category, lighting saw significant price erosion. To offset that, a lot of cost initiatives has been implemented to ensure the margin gets robust. Combination of these two has helped us to reach today not only industry leading on growth for the last 2-3 quarters, now industry leading on margins and lighting also. As we move forward in the short term, we want to invest some of these margins back for growth by spending in advertisement and brand building. But as we move forward, we think that should also lead to higher growth and get back onto the similar margins on a sustainable basis.
Excellent. Mr. Arunachalam, it's a great story playing out, and we'd love to chat more, but frankly, out of time on this one. But thank you so much for coming in and giving us that perspective. Viewers, just a quick one. The analysts are really penciling in a top line of 8,000 crore in FY26, a 10,000 crore top line by FY28. And here's where the kicker is. PAT guidance is, or rather, PAT estimates are at 500 crore for FY26. But that will rise to 750 crore basis consensus in FY28. So 50% growth in the 2 years between FY26 and FY28, which is likely to get penciled in, which will compress the price to earnings to 22 times if this were to play out. So it's an interesting story playing out. Of course, the commentary coming in is positive. Price hikes plus. All of that likely to get built into margins and profitability. But all the time we have on this edition of the show. Hope this was useful. Stay with us here on ET Now. More action to follow.